Hello and welcome back. Today we're looking at an analysis report. Don't panic sell DFLI Slim, the bull case for a 2026 comeback.
Right.
It argues the recent drop in Dragonfly energy is a structural event after a reverse split, not a fundamental problem.
Yeah.
So, a key theme running through this analysis seems to be a case built on three main pillars. Evaluation disconnect, the potential of their solid-state tech, and this necessary compliance reset. It's an incredibly high-energy read.
It is. It's definitely engaging. I wonder, though, if we've considered how that sheer intensity might actually work against what they're trying to do.
How so?
Especially if they're aiming for, institutionalize after this split. I think we need to look at the style first.
Okay, the writer is clearly passionate, almost aggressive about the opportunity. As I get it from the notes, the argument is that the urgency, the contrarian language, things like be greedy when others are fearful, it's meant to motivate investors who are panicking right now.
That makes sense. I get the impulse. But the highly emotional and urgent tone, while it is engaging, it really risks undermining the objectivity you need for a sophisticated analysis report.
You think it goes too far?
I do. The material relies so heavily on this high-energy, superlative language. We see biggest mistake, moonshot, lottery ticket, super recovery. All of these are used to drive the point home.
Right.
And this emotional framing, particularly for a financial analysis meant to be robust, well, it can introduce skepticism in the mind of a savvy analyst.
Because they expect something more measured.
Exactly. It shifts the focus from the supporting data to just an emotional appeal. It feels less like an investment case and more like hype.
Wait, I have to challenge that a little bit. If they're trying to appeal to the panicked retail investor who's dumping the stock right now, doesn't adopting a sterile institutional tone risk losing that audience completely?
It's a fine line, I'll grant you that. But the conviction should come from the strength of the analysis, not the volume of the language.
So the numbers should do the shouting.
Precisely. My suggestion is to calibrate the tone, be measured, be analytically contrarian, prove the bull case through detailed data and scenario analysis, not through pure urgency. The goal is to establish conviction based on numbers and market mechanics, not adrenaline. You prove your thesis by being the most rational person in the room, not the loudest.
Okay, so give me a concrete example. How do you do that without sounding boring?
Sure, so instead of framing bull argument number 2 as the solid-state lottery ticket, which sounds like a pure gamble.
Right. Very speculative.
Reposition it as the strategic optionality of patented solid-state technology. That immediately frames it as a calculated business path.
Okay.
Or replace phrases like the fear is off the charts with something specific, something verifiable. For instance, implied volatility suggests a severe overestimation of immediate bankruptcy risk.
That sounds much more credible.
And critically, this is non-negotiable for a professional report. Integrate a mandatory, clearly defined section that details the risks.
So you tackle the bear case head-on.
You have to. Don't hide the headwinds. Analyze them. Title a section Key Risks to the 2026 Thesis and detail potential delays in OEM partnerships or unforeseen capital needs. It shows you've considered the complete picture, which dramatically elevates the credibility of the entire report.
That integration of a formal risk assessment is key. It signals maturity. Okay, let's assume they make that shift in tone. We still have to look at the substance of their core financial claim.
Yes.
The analysis makes a strong case for a big valuation disconnect. It highlights that DFLI is trading at a price-to-sales ratio of, about 0.8x?
Compared to an industry average of 2.5x to 4.0, yeah.
It's a very compelling observation. It implies the company is priced like it's about to go under completely.
That 0.8x PS figure is a powerful hook. It grabs your attention. But the analysis is fundamentally incomplete if it just stops there.
How so?
The valuation argument relies on that simple PS comparison, but it needs to address the market's specific reasons for that deeply discounted ratio to be truly robust.
So it's not enough to just point out the number.
No. The weakness here is that the analysis lacks any detailed exploration of the counterarguments that justify the low multiple. For instance, it doesn't explicitly address liquidity issues, outstanding debt, or potential future dilution.
Things a serious analyst would immediately flag.
Immediately. And if you don't introduce and then dismantle the reasons for the low PS, the argument just feels hollow. It leaves the most painful questions unanswered.
Why is ignoring debt such a critical oversight here specifically? PS is a common metric.
It is, but CS is fine for capital-light companies or, startups with clean balance sheets. DFLI is navigating financial pressures, regulatory issues, and needs significant R&D investment.
It's a different situation.
Completely. When a stock trades below one-time sales, the market isn't saying the sales are bad. It's saying there's a high probability the company won't survive long enough to realize those sales. It's pricing in insolvency risk.
Okay, so what's a suggestion? How do they fix it?
My suggestion is to bolster that first argument by introducing and then explicitly dismantling the most likely bear arguments. Use the current financials, like the $16 million in revenue last quarter, not just as a static number, but as part of a forward-looking cash flow projection.
Show the path to solvency.
Show the path to solvency before the 2026 catalyst is even expected to hit.
So you can't just present the strong numerator, the sales, without defending the suppressed denominator.
Exactly. And we need concrete examples here. First, move away from just PS. Include a brief, sharp section on the balance sheet's ability to absorb costs. Introduce the enterprise value to sales ratio, EV sales.
Which includes debt and cash.
Right. It gives a much more honest picture of what the market is truly discounting.
Got it.
And second, define the operational runway. For example, state explicitly something like, while liquidity remains tight, the estimated X amount in cash, coupled with projected revenue from RV battery sales, provides Y quarters of operational runway, mitigating immediate bankruptcy risk.
That one statement is more powerful than 10 paragraphs of hype.
Because it neutralizes the primary bear concern, imminent bankruptcy, with cold, hard numbers. It shows the company can survive long enough to get to that 2026 inflection point.
Defining that runway provides the time horizon for the rest of the thesis to even matter. It grounds the speculation in reality. Okay, let's move on to the structural link between these immediate fixes and the long-term payoff.
Yeah, this is a big one.
I'm looking at the structure of their three-pillar bull case. The report jumps pretty aggressively from the immediate catalyst, the compliance reset, to the highly speculative one, the solid-state patents.
It is a jump, and this is where the narrative connection really needs to be strengthened. The analysis treats the three arguments as if they're equally weighted, but the connection between the reverse split cleanup and the massive solid-state potential needs a much more defined bridge.
You're saying the dots aren't connected.
The dots aren't connected. The weakness is that while it successfully establishes that the reverse split removes the ceiling for institutional investment and that solid state offers massive upside,
Right.
it doesn't clearly show how removing that compliance threat translates into accelerated development or funding for the solid state pipeline. It just feels like a completely disconnected event, a separate hope that relies on good fortune.
But isn't the connection implied? Post-split, institutional buying elevates the stock price. A higher stock price enables easier funding, which pays for the R&D. Is that not a sufficient bridge?
That's the obvious bridge, but it's too passive. The analysis needs to define the active mechanism. My suggestion is to refine the structure so the compliance reset is positioned as the explicit prerequisite for unlocking the value in the cash cow revenue.
The RV battery sales.
Exactly. Which then funds the moonshot technology. You have to emphasize that institutional buyers, now able to participate, are investing because the stable existing RV battery revenue provides the internal capital base needed to sustain the solid-state R&D into 2026.
So the compliance reset is less about a technical hurdle and more about allowing the market to correctly see the current operational stability.
Yes!
And that stability is the engine for future growth. The RV business isn't just a valuation counterpoint. It's the funding vehicle.
Precisely. Let's use a narrative bridge to tie these pillars together. Make the conclusion feel inevitable, not speculative.
So a concrete example would be what?
You structure the summary to explicitly link the points. The compliance reset facilitates institutional reevaluation. This allows the market to properly price the ongoing RV battery revenue, which, critically, provides the internal capital needed to drive the solid-state pilot line. See how it flows?
It's a direct causal chain.
And another example. Define the necessary operational success metric. If institutional buyers are now looking, what specific metric must DFLI hit next quarter to prove the post-split flush is over and the funding pipeline is secure?
Like a specific reduction in SG&A costs or a Q3 revenue floor?
Yes. Give them a metric to watch. It makes the entire analysis actionable, and it validates your narrative structure.
I appreciate that focus on making the linkage operational rather than just based on sentiment. The core thesis is strong and contrarian.